Welcome to the Furlough Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both properties and residences so that together we can build wealth while improving housing. I'm James, and this is my free sweating wife, Jessie.
Oh, man, that's embarrassing.
I just outed you. Yeah, so for those of you, who don't know what a free sweater is,
I sweat when
it's not something you wear.
Nope. It is not a free garment.
No.
I just sweat.
You just sweat.
I sweat when I'm sleeping. I sweat when I move around. I sweat when I work out. I sweat when I don't want to.
Are you sweating right now?
Now I am.
Cooled...
I'm embarrassed. No,
oh man,
I'm not sweaty right now.
Yeah. Whereas I'm opposite. Like I get like a mile into my run, I'm like, I think I'm starting to sweat.
Oh yeah, and I'm like dripping.
And you're like, what is wrong with you?
Dripping sweat.
Yeah, you're sweating when you're putting on your workout gear.
Sometimes it's like highly annoying because I'll be trying to like put makeup on and I'm sweating.
Oh,
and
that
would
like,
be. What is happening right now? Stop, body, stop.
Stop, body.
TMI.
Oh, man.
We all know now.
That's so gross.
Wow.
Man. You're welcome for that.
All right, let's move on,
So,
I guess.
Yeah, let's talk about sweat equity. That's what I want to talk about.
Okay, yes. I wish I built equity by all my free sweating.
Man,
but
dude, you'd have so much
I do
equity.
not. If I had a nickel every time I sweat.
Oh, that'd be gross. You'd have a lot of nickels.
Okay, anyway, sweat equity.
What is sweat equity? Do you know what that is?
Yeah, it's like doing hard work to improve something.
Okay.
Usually a property.
That's like half the equation. You do the hard work to improve it, and then as a result,
sell it. You get a higher value for it.
Yeah. So the idea is it's a way of increasing the value of whatever it is, a property in this case,
sure,
by putting in work yourself. And I'm gonna slightly adjust that for you there, so that instead of say like paying a contractor or something like that, yeah, exactly. So. That's the idea. And it is a classic flipper strategy. When people first get started, that's what they do. They find a piece of property that's in bad shape. Yep. And then oftentimes they will do the work themselves and capture that sweat equity.
It's also super fun to use power tools.
Also fun, yes. And then they sell it, right, or refinance it to capture that value that they created with their own blood, sweat, and tears.
Yeah.
Sweat equity. Oftentimes, we talk about that with homeowners as well, right? You buy a property and we're putting in the sweat equity because they're doing the work themselves.
Yeah.
Like it's code for DIYer in a ways, which is totally cool.
Doing projects yourself so that later you'll get the value out of.
It's a classic strategy and one that we try not to do.
Really?
Yeah. I know, right?
Why?
Counterintuitive. Because what we want to do is we want to pass on the potential for sweat equity to the next person.
Oh, okay.
Yeah. So what we'll do is we'll do enough to make it lendable so that someone can qualify for conventional financing.
Yep.
And then we find some nice middle ground where we go, yeah, this would have been the profit had we gone through all of it, maybe even slightly less. And then we just sell it to that other person with more upside for them. So like, for example, we're going to buy this place that it could be worth, if it's all fixed up, worth like 380, 390, something like that. And we're going to buy it and not do any of that because we're able to buy it for 300.
Okay.
And instead we'll sell it for something like 340. And we'll do like basic cleaning type of stuff.
Yeah.
And so, we're giving up
any necessary improvements to get it lendable.
Yeah, and so we're giving up that $50,000 of potential upside, but we would have had to spend quite a bit to get that maximum value. And instead, we're going to let someone else do it. They'll do their sweat equity and get out of it. And so, I actually I have an example here of kind of how this works mathematically. Ooh. Because I want to walk you through it. So let's say
like examples, and
this is simplified. I get that.
this
is apocryphal.
There's been some big rounding.
It's not 100% accurate.
For this to work.
I get this. But hey, if you want to throw spreadsheets at me, go for it. I love it.
All right. Good disclaimer.
Let's say that you buy a place for $100,000. And you're doing a bunch of repairs, but one of them specifically is a $15,000 kitchen remodel, right? And it'll increase the property value by $30,000. Again, this might be like just that all by itself. There might be other stuff going on. I don't know. But it's a great hey, put in the 15, do that. But to do that $15,000 kitchen remodel, let's say there's like $7,000 in labor that has to happen, right? So typically what a flipper does is they spend the 15 grand plus whatever holding, lending, whatever costs that are there. They then sell it for $30,000 more than what they bought it for. And so they would profit, in this case,
15.
Yeah. And maybe there's like, I actually forgot to add a number here. So all those lending, holding costs and stuff like that, let's say it's like $5,000.
So they make 10.
There you go. So they make 10. Cool. So what we would do is, I have all the math here. Yeah. 100,000. I don't know why I did it twice. 100 plus 15 for the rehab, 5 for the holding, reserve, contingencies, whatever, 120, sell it for 130, 10K profit. So what we would do is buy it for 100 and then sell it for 110.
Oh, you still make 10.
And then so the
It's
buyer
still a
comes
deal
along,
for the buyer.
they buy it for 110. They spend the $8,000 still on the materials. They paid, so that's 118. So now they have 12,000 from sweat equity because it's still worth 130 at the end of the day.
Yeah. Win-win.
Yeah, right? Exactly. Except for the contractor. I guess they don't win. But that's okay. There's plenty of
Well.
work to go around for contractors.
Yeah. I mean, it's true that homeowner may or may not do everything DIY. And so,
Yeah, true. And that's the other, that's
can
the
make
cool, that's
decisions.
actually the cool part about it, right? Like in theory, if they decide not to
put in
do
the
it
sweat
all,
equity,
like,
they
they can still pay the $7,000 and there's still a little bit there of equity left. And this is something that we actually did with a property last year on, it was on 16th Avenue where it was a guy, he was in pre-foreclosure and it was super messy and it had to move fast. So you couldn't do conventional lending because like you had to go fast.
Yeah.
We ended up buying it. It needed a roof. It needed some other stuff fixed and needed all the garbage cleaned out for one. And so we went through and we did enough to get it lendable, which one of them was, it was funny, the new buyer, he was going to put in all new flooring,
Right.
but in order for it to be lendable, you had to have carpet. And so we just bought some
Cheap
cheapy
stuff.
remnant carpet and just laid it in. Like didn't tag it down or anything. It just laid there so that the appraiser was like, cool, you have carpeting, you qualify. We're like, this is so dumb, but whatever. And so that was exactly what we did. We kind of found that number where he was able to buy it. And he's been putting in the sweat equity, borrowing my tools, which is cool, but putting in the sweat equity to make it better and just capturing that value for himself. And which has been great. And we've got some profit out of it as well.
which just kind of open up different opportunities. You know, he could fix it up and stay there and now have a really nice place and like have this value that he's put into it. Like, I did that.
the
I fixed
pride of
that.
ownership.
Yeah, the pride of ownership. But he could also fix it up and sell it and take that,
Totally.
Difference and then
Snowball
put it into something else.
Yep. Yeah, there's all sorts of wins. I try to count a lot of them. For us, there's a win. It's less money for us to raise.
Right.
Instead of having to raise like in this like that whole 15,
Yeah.
you just don't, which is cool.
Well, it's less work.
Yeah, well, the way I said that is it reduces our risk.
Yeah.
'Cause
I guess that's in
we're
my
not going to
head, that's
find
what I was
unexpected
thinking.
repairs. We're not going to risk having an inaccurate bid. Or here's an interesting one: accidentally over improving it for the neighborhood.
Right.
Yeah, that's a thing.
That's a thing. Because I can imagine, like, you get in there and you start fixing stuff up, and it's like, if your personal preference gets layered in there, and then you're like, well, this type of flooring or this type of fixture or this type of cabinet is just better.
Yeah.
It's like, okay, well, you have to make hard decisions sometimes to be like, well, yeah, it might be better in general, but not for this particular market or neighborhood. And
Yeah. Speaking of the
interesting.
neighborhood, I think it's better for the neighborhood too if you got an owner who's doing all that work and they got the buy-in, they have that pride of ownership, it's designed the way that they want. I think it's good.
yeah.
And the way that we've been structuring it so far is that there is enough equity where if they wanted to hire someone, that's still an option. I think it shares the wealth, right? We're not just trying to grab it all for ourselves.
Sure.
Though obviously some would have gone to a contractor. And just in general, it's still a way to improve the neighborhood. And just doing it feels more organic, I guess, rather than just like coming in and doing all sorts of stuff. So if I had to put it into a single statement, it would be sweat equity creates wealth for buyers, improves housing stock, and aligns with our mission at Fertile Capital to uplift neighborhoods, improving neighborhoods while building generational wealth. It's kind of like, so for us,
pretty cool.
it's been a cool strategy to not do the sweat equity
Yeah.
and instead pass that on. And
What do you call that? Because like a traditional flip, is you buy it, you improve it, and then you sell it.
Yeah. There's the kind of fun name. It's all right. It's called a wholetailing.
Yeah.
So you have wholesaling and then you have retailing, right? So wholesaling is, hey, we bought this place for, I don't know, whatever. We got it for cheap. And this is what a lot of wholesalers will do. They get it super cheap and then they do just a small markup and then they sell it to a flipper. And then the flipper goes and does all the work and captures a lot of that value.
But they
and
have to
maybe that
find
wholesaler
the
makes
property.
somewhere between like, $5-10 grand
Okay.
for it. Maybe,
Sure.
I don't know, something, maybe more, maybe less, whatever. Depends on how good a negotiator they are. And so for a wholesaler, their whole name of the game is like, yeah, we're trying to do, 4 or 5 of these a month type of thing. And just constantly are rotating through. Yeah. But they're not doing any work. And as a matter of fact, they don't even want to close on the place.
They're finding all the deals.
Yeah, exactly.
Yeah, that's the
And
value
then
they're
the
adding.
retail side is what that flipper does, right? After they've bought it and fixed it up, they're now selling it to an end buyer, a homeowner.
Yeah.
And that's the retail buyer.
Okay.
So we're kind of
Interesting.
we're smashing those two together.
Yeah.
And saying, well, we're not going to resell it at that wholesale price, but we're also not going to sell it at that retail price. We're going to find that middle ground because we're going to put in a little bit of work probably. And wholetail. That's the term for it. And just
you're right. It needs a more interesting name.
Yeah, it's okay. But anyway, either way, it's a good strategy. It's one that I like. It kind of fits my personality too. And it means I don't have to have a crew running around everywhere doing all the work, which is also okay. Yeah. There are other properties where we do go and we go for it and we fix it all up and we spend all the money and do it. It just kind of depends on the situation and what we think we can get away with. But yeah, but anyways, super sweet and easy.
Nice.
Sweat equity. That's what we do. It's part of our strategy. And if that sounds cool to you and you're like, yeah, I love that strategy. I love what you guys are doing. It makes a lot of sense from a business model risk standpoint and makes a lot of sense for the neighborhood and the ultimate buyers. Man, I would love to talk with you. That'd be awesome. You can check us out at furlough.com and you can learn more about just what we're doing from an investment standpoint and how you can get involved. So that'd be great. So with that, thanks for listening and have a great day.